to Real Estate Unlocked, your go-to podcast for real estate tips, expert advice, and everything you need to make informed property decisions. I'm Brent Govan, your trusted guide in navigating the property market with confidence. In today's episode, we're going to dive into one of the biggest debates in property investment: cash flow versus capital growth. Which strategy is right for you? Should you invest for immediate rental returns or focus on long-term appreciation? Stick with me as we break down the pros, cons, and key considerations for each approach. Let's start with the basics. First, cash flow strategy. This approach focuses on properties that generate strong rental income, ideally covering all of your expenses, such as mortgage, maintenance, management costs, etc., while leaving you with a steady profit after each month. They're high yield properties, often in regional areas or lower price markets. Sometimes apartments, townhouses, units typically suit this strategy. Now, the capital growth strategy is all about buying properties in locations with strong long-term appreciation potential. They may not always deliver high rental yields. Ideally, you get both. The goal is to sell at a much higher price later, building wealth through increased equity. So which one is better? Well, depends on your financial goals, your risk tolerance, and your investment timeline. Let's compare the two. Now, the pros and cons of each. Let's kick off with cash flow. The pros of cash flow: it is immediate and it's consistent rental income. It can help you cover your mortgage, repayments, other expenses. It's less reliant on the market cycles and therefore provides stability in downturns. Its potential for financial freedom is much sooner. The cons: so the amount of money you make over a longer duration, for example, a 10-year period, is likely to be less. It has higher vacancy risks in some markets. Property values may stagnate if located in lower growth areas. On the flip side, capital growth. Its pros are that it's long-term wealth creation using equity growth. It provides potential for refinancing to reinvest and therefore create a portfolio of properties in time. It gives stronger returns over extended periods. It's often in more desirable locations with strong demand. The cons of capital growth is that it is typically lower rental yields. You may therefore need to supplement your mortgage costs. There are market fluctuations which can affect short-term value. You can get caught out with a growth strategy where you're actually making a purchase with the intent of selling in 10 years' time, knowing it's going to be a great deal. But you may come across some personal challenges or difficulties financially, have to sell quicker than that. That may not be the right timing to take place. It requires patience and a long-term outlook. With that in mind, which strategy should you choose? Let's discuss some more factors to consider. Your ideal approach depends on your personal circumstances and goals. So here's some guiding questions for you. Are you looking for immediate income to supplement your salary? If so, then a cash flow strategy may be best. Or do you have a long-term vision and can afford to hold on to property? Then capital growth might suit you better. How comfortable are you with risk? High growth areas can be more volatile, while cash flow properties provide more stability. What's your borrowing capacity? Lenders often favor high income investors, but capital growth properties can offer better security. Lots of questions. Ultimately, a balanced portfolio with a mix of high yield and high growth properties can help you maximize both income and long-term gains. Let's take a look at these two real-world scenarios. Example 1 is sit around the cash flow investor. Emma purchased a $400,000 property in a regional area with an 8% rental yield. She earned $600 per week in rent, covering her mortgage and expenses while pocketing extra income. Over time, she built a portfolio of cash flow positive properties that allow her to replace her salary with passive income. Second example scenario is a capital growth investor. James buys a $700,000 property in example 2, the capital growth investor. James buys a $700,000 property in an inner suburb with high demand. The rental yield is only 3%, meaning he needs to cover some expenses. However, over 10 years, the property appreciates to 1.3 million, allowing him to refinance and reinvest in more properties during this time. Both strategies work, and if they align with the investor's long-term plans and financial situation, either are a winner. So, in conclusion, there is no single strategy that's right for everyone. The key is understanding your goals and choosing an approach that fits your financial position and your risk tolerance. Is it short term? Is it long term? What's your take on this? Have you focused on cash flow or capital growth or a combination of both? I'd love to hear your thoughts. Connect with me via email or on social media. Leave a comment. And if you found today's episode valuable, don't forget to subscribe, leave a review, share this podcast with your fellow property enthusiasts or your mates. Until next time, happy investing, and remember, knowledge is power.